Okay, welcome everyone. And thank you so much for joining us for this webinar tonight on smart tax strategies for savvy real estate investors. So before we get started, just a quick disclaimer. The following content is only for informational purposes and of general nature. The information shared, conveyed, and elucidated in this presentation is not intended to constitute any legal, tax, accounting, or investment advice. Any ideas or strategies discussed should not be undertaken by any individual without prior consultation with a financial professional or independent research. So, thank you again for joining us. I'm Margaret Kozlark. I'm here with my host, Christine Shu, and just wanted to tell you a little bit about us before we get into our featured guests this evening. So I have been personally investing. I started as an LP in 2016. And I have invested as an LP as well as a GP and a fund manager in over 1,900 doors, mainly in the Southeast, as well as Texas and Indiana. And I am also a real estate agent with Keller Williams. My partner, Christine, started on the active side of real estate. She currently owns 6 rental properties in Philadelphia and Westchester. She's been a GP, LP, and a JV, as well as a fund manager on multiple syndications, again, in that same areas that I do, spanning over 2,000 units. And together, Nobly Vest has over 125 million in assets under management, representing 3,000 units, and we've had 6 properties go full cycle. So we are very passionate about real estate investing. But now, the woman of the hour, I am so honored to introduce Tobi Agbejimi. She is a CPA focused on helping real estate professionals optimize their relationship with the IRS. I love that expression. She is also the founder and CEO of Doba Tax and Accounting and Doba Capital Solutions. And she is a tax strategist focused on helping put together entities, tax planning, accounting budget, and profit analysis, and basically to help you keep more of your hard-earned money. So Tobi, I am going to stop sharing my screen. I will turn it over to you.
Thank you, Margaret, and hi everyone. Hello, Christine. Can you guys see my screen?
We can.
All right. Thank you so much for having me today. It's an honor, and I do not count it. I take it up as a privilege. So I appreciate the invite. So today we're talking about the smart tax strategies for savvy real estate investors. But before we go on, let me tell you about who I am and why you should listen to me. My name is Tobi Agbejimi, as said already by Margaret. And first, I am a wife to a real estate investor who happens to be a former pediatric nurse. He did nursing for quite some time. And in the process, he wanted it to start as a real estate investor, but then he went into he got his real estate agent license, became a real estate, a realtor, and we started growing the portfolio from there. And I'm also a mom to 3 amazing champs. Again, I'm a real estate investor CPA. So I did not start out as a real estate investor CPA. I started out as just normal work, being an accountant, and then filing taxes. But something triggered my attention, which is what happens majority of the time. Being a tax preparer is different from being a specialist in a particular niche. So I saw the fact that people kept paying. By the time we're done with taxes, majority of people were so sad looking, very unhappy about how much they have to pay back to the IRS, the check they had to cut. And I felt like, I'm seeing my husband's situation as well. I was like, no, there has to definitely be something out there. And this, we all know the tax code is 70,000 pages huge. And majority of people don't even know, we can't even finish up 5,000 of it. So I decided to niche down to savvy real estate investors. You can say my husband was my motivation because I wanted to save taxes for my family. But outside of that, I got into communities, into different high net worth communities, because this space is not a space where you tell yourself you know it all. You have to be amongst a group of people who are like-minded, who serve the same niche, who are doing almost the same thing that you do. And that way you're able to keep yourself abreast of all the information and be on point as much as possible. And while we were serving, when I started serving the real estate investors, I then realized that there was a problem in the industry. I see myself as a solution provider most of the time, because again, it's not enough to see problems. It's about seeing the solution within the challenge. So I discovered that many people, many investors, when it comes to funding their deals, they were always like running from pillar to post, not finding the right kind of funding. And that's right there, the Doba Capital Solution. That was how Doba Capital Solution started. And the company, we partnered with a lot of private fund, different banks to get access to help our clients access capital. Initially, it was for the Doba clients, and then we broaden it up so that many other investors who are not at the moment our clients from the CPA side of things, but just to give additional value. That's how real estate, the Doba Capital Solution started, and we've been growing and thriving and doing very amazing, giving many very amazing opportunities to both investors and even small business owners. So I'm also a live producer, because again, my goal is to help people, investors, business owners, build the wealth and tax strategies that they can leave for their legacy, for their children's children. And one of the vehicles that we also use is life insurance. So I became a life producer. My background, actually, I have my bachelor's degree in insurance. So that made it easy for me to be able to flow into that space as well. And what we also discovered that some people have this fund, they are not based in the US, they want to invest, they want to have properties in the US, and that led me to being an IRS certified acceptance agent. So I'm able to prepare an ITIN for anyone, anywhere, as long as I can validate and do my forensic audit on their documentations. They are able to get their ITIN, and then they could be part of the investors, passive investors, with Nobly Vest and every other kind of properties that they want to do. So you see two pictures of me in this slide. I am constantly evolving. The one on the left, you see, it doesn't really look like the Tobi you're seeing today. And that's because I keep evolving personally, and just the way I evolve personally, that is the exact same way the business evolves. We'll keep growing. Today, you're hearing us as having Doba Capital Solution, being real estate investor CPA. Next week, you might see something else, and this look might change next time you see me. So let's keep it moving. So today, we're going to be talking about how you can save tens or hundreds of thousands in taxes, even if you already have a CPA. I do understand that majority of us, we already filed our taxes 2 days ago. Today is the 18th. Yesterday was just the deadline for extensions. Many tax preparers are so unhappy about their results, looking at the amount due back to the IRS. And we understand that you probably have your CPA, but we just want to tell you some strategies that is out there, especially for you guys in this group who are passive investors. So here is what you think you save when you prepare taxes. In my picture, you see the arrow up here is saying this is what you think you save when you file your taxes, because everybody filed their taxes and they're like, oh, my tax preparer got me this deduction, got me that deduction. But below there, when you look at the picture, is actually what you can save when you involve yourself with tax planning. So there is so much opportunity that is available for investors, for business owners, that you all could utilize legitimately. Okay, this is not some backdoor policy. The IRS created it. They want you to use it, but they will not come and show it to you, because again, the IRS is a collection agency. They want to get as much as they can get from every single person's earning. But if you are able to align yourself with experts in the industry, with good a good team of people, both from the legal and tax aspects of things, including a bookkeeper, where everything is on point with your businesses. You have all your expenses and income, not leaving anything on the table. And you have someone who knows the in and outs to help you save depending on your specific situation per time. Then you could actually be saving so much more, as opposed to when you just typically get all your papers in, maybe during extension or during tax season, and all you're doing is filing your tax return. One of the biggest misconceptions that small business owners, individuals, investors, passive, active, whatever, majority of people think is the belief that their tax preparer is saving them money on taxes, but they aren't, they're just preparing their returns. I just explained that, and tax preparation is equals cost. Why is that? Every single one of you, after you filed your tax, even before you file your tax, you had to make a commitment to your preparer to say, okay, I am going to pay you. Some of you do a monthly plan where you pay do a prepayment and you pay gradually towards your fees. Some of you have to pay a portion before they even get started on your tax return. Some of you get to pay at the end, maybe because of relationship. But whether we like it or not, tax preparation equals cost. But what is tax advisory and tax planning services? That is an investment that will always yield a return. When you involve yourself with planning, you're already looking at what do you want your situation to be at the end goal. You have the end in mind, and then you're working yourself backward with your professional, helping you to realize and implement those strategies that he or she would come up with to help you minimize your tax liability. Partner with the IRS in such a way that the IRS will be able to fund your next deal or fund your next syndication investment into Noble Invest. But when you do not have access to information, or you're going, some people just want to go cheap. They say, my preparer is asking me to pay this amount. I feel it's too much. When you do cheap, you get cheap. Okay. But when you know that you really want to save, you want to imagine how much you could save if your tax advisor saves you a huge amount and you put that in some with Noble Invest. Imagine how much return you get on that. So at the end of the day, instead of giving Uncle Sam the money, we are a believer of let us turn back the money into yourself, into your business. If you like, go on a vacation, you deserve it because you work so hard to earn that money. If you want, you can give part to Christine and then go on vacation with the rest, or do whatever you want, but you deserve to enjoy the benefits of your own efforts. And that is what tax planning is all about. So what then is tax advisory and what then is tax preparation? The old way, which I used to be, where I started from before I began to think that there has to be a better way out there for everyone to be able to minimize their tax liability, optimize their relationship, optimize their tax situation, was just tax preparation. And what do you do when you're preparing tax? You're just bundling all the documents. It's an after the fact thing. It's like doing an audit. Everything has happened. They're checking to see if your papers are correct. So tax preparation is the process of preparing the tax return for submission, because we all are obligated to do that piece. It's a compliance piece. We have to do it, whether we want to do it or not, whether we're happy to do it or not. You are obligated to do it. If you don't do it, the IRS will come after you. So that is the old way of doing things. But what is the new thing now? It is tax advisory services. And that is the process of providing monthly or quarterly consultation with your tax advisor, be it your CPA, in conjunction with your legal advisor. You need a whole team, a full team of professionals to back you up, because your tax advisor would look at the lens from the aspect of taxation. Your legal advisor, which is your attorney, it could be an asset protection attorney, will look at it from the legal side of things to ensure that they minimize your liability as much as possible. Because you know what, in this country, lawsuits is very common. And the minute people see that you're making a little bit of money here and there, you start having one property, two properties, they start looking for ways to take away what you have earned. And they become predators. So you have to make sure that you're guarding yourself against predators. Be prepared so it doesn't catch you unaware. So that is what tax advisory does. And the way tax advisory works is from the beginning of the year to the end of the year, you're carrying your advisor along, letting them know, okay, at this point, this is the first quarter. This is how much I make. This is how much I think I'm going to make in the next quarter. And then you guys are strategizing to see, okay, with this way, the projection is you're going to be paying this. What can we do now? What can we put in place? What vehicle can we implement to ensure that we only cut the check we want to cut to the IRS? You have the ability to be able to decide how much do you want to give Uncle Sam at the end of the year. But if you're not doing tax planning, sorry, it's not going to happen. You pay what they ask you to pay, and then you don't get upset when that happens. So tax strategies for many business entities start from entity structuring. Over 23 million of businesses in the US are not properly structured. Why is that? Majority of people think about a business idea. Before you say Jack Robinson, they registered it's some sole proprietorship, they're doing the business without knowing that sometimes before the starting point is where you need to get it right. If the foundation is destroyed, there's not so much anyone can do. You either get it right the first time and keep it moving, or you get it wrong and you pay again to get it right. So you want to consult with your CPA, your asset protection attorney. You're going to hear me keep saying this almost throughout the presentation, because those two, including your bookkeeper, you need an whole team. Just as you possibly have a realtor in your life, you need a bookkeeper, you need an attorney, you need a tax advisor, you need, what else do you need? You need a banker, because when you need money, or you need Dover Capital, okay? You need to just make sure that you have all this team of people around you. You want to consult, make sure that the attorney, and when you're doing tax planning, what they do is they look at the holistic picture. They don't just look at today. Tax planners that just look at your situation today are not doing enough for you. They need to look at what is your goal? What is the end goal? This is point Z. Where are you today? This is point A. The in between the line, they want to make sure that they fix the in between the line for you to help you accelerate your Z forward. Maybe your Z is supposed to be in 20 years, to help you push it forward so you can retire on time, enjoy your life, spend time with your grandkids, spend time with your children, and enjoy what you want to have, what you want to have in your life. So when they are doing legal entity review for you, they're looking at your sole proprietorship, your partnership, whatever form of entity that you have going on. How can you optimize it? How can they make sure that you are not liable if someone sues LLC A? How do they ensure that your entire life savings is not affected? For Adoba, what we do is we work with real estate attorneys, asset protection attorneys, and estate planner attorneys. We work in sync together. We refer our clients to them. We evaluate the entity structure of the client. We look at where you are, what do you want to achieve. We draw the map of your entity, of your current structure. We draw the map of what we think you should do from the tax lens, and then we share it with the asset protection attorney. And that's why I said we work as a team. We share it with the asset protection attorney. Could be your asset protection attorney, could be the one, if my client don't have, we share it with the one, our asset protection attorney that will refer our clients to. When they look at it, then the attorney and the CPA talks back and forth to ensure that both goals are accomplished. We want to make sure the client is paying the minimum tax, the least tax as possible, as well as being protected for the future, for the sake of their children, for the sake of themselves, because we all work hard to put all these things together, and we don't want to lose it within a split of a second. So what does tax planning cover? Again, it covers deductions. When you're doing tax planning, your tax advisor should be checking what are the diverse deductions that is possible for you to deduct. What is your legal entity structure? Can we put in place some retirement strategy to defer your income into the future? So instead of paying Uncle Sam this money, can we defer it into your future? How do we change your end income into ordinary income? How do we change your ordinary income into portfolio income? How do we turn your portfolio income into an exempt income so you don't ever pay tax? It is not illegal not to pay tax. The law, as it's there, they have to find out what is the loopholes that is available. Will you be able to use the infinite banking model, the wealth, the vehicle of life insurance? Look at the Tax Cuts and Jobs Act. Look at your niche specific strategies that is adaptable for your specific situation. I keep saying specific because there is no one size fits all. My goal is different from Christine's, is different from Margaret's. Everyone has their own specific goals, and at the end of the day, it has to cover what I want to achieve. Do I want to bring my children in business at age 10? Do I want to start paying my kid? If I'm paying too much, how do I bring my kid into the picture? How do I bring my parents into the picture legally to be able to reduce my tax liability? All of this is what your tax advisor would be looking at when you're doing tax planning. Now let's talk about this niche specifically, because you guys are real estate investors. I believe majority of you are passive investors investing in syndication deals. You have your other businesses or you have your W-2 jobs. So let's talk about what are the different types of income. Let's start from there. Now, there's the active income, which is also called earned income. And with the active income, these are income that you derive from your job, from your businesses. You are participating materially in those activities to generate the income. If you're not doing the work, then you're not making the money. So those kind of income is called active income. Passive income is those income that you generate from activities that you do not do anything about. You are not doing anything, you're just sitting on the side and your money is over there working for you. You sending, they say you send your money on errand to go make some extra for you. So that is what passive income is. And then portfolio income is the income that you get in the ordinary course of, trading as so attributable to interest, dividend, royalties, when you dispose your properties. Those are portfolio income. Now let's look at what are the different types of investors. You have active investor who is fully on ground doing what they're doing, spending time. All they do is real estate. Again, what we are specific about as to real estate investing now. And then you have the passive investors, like I said, who is enjoying the benefits of time, just as you guys. For as many of you that are investing in the syndicate, what you do is you put some of your money, you give it to Noblevest invest it, and then the properties, if they're holding it long term, you're generating the benefits of time, because there are two ways to earn. It's either via effort or time. When it's effort, that's like some active income, but when it's time, that's like some passive income that you generate more from the appreciation of the property or from the time value of holding it. And there's also the real estate professional. And in that world, there is so much of tax benefit that is available for a real estate professional. So any trade or business of the taxpayer, which the taxpayer again does not materially participate, according to the IRS, they are classified as passive activity. So what happens with passive activity is that any loss from passive activity is only can be offset with income from passive activity as well. So for example, when you invest in, let's say you invest in the syndicate and then you get some losses, at the end of the day, if you have some, and let's say in another business space, you invest money with a restaurant owner who is making out, who is always making profit, then you are able to net the losses from the real estate with the income from the restaurant. But there is something called passive loss allowance. So with respect to real estate, the IRS sees every real estate as passive income. But there's exceptions to that rule. And I say as passive income, because for a passive income, generally in taxes, your passive income as to your passive loss can only offset passive income. You cannot offset your passive losses with your active income. Remember, I already defined what an active income is. Those are income from your materially participating activities, such as your job, your businesses. But there is an exception to the rule of passive as to net against passive. And that exception is that the IRS allows you, if your modified adjusted income is less than 100,000, you are able to deduct 25,000 of your passive loss against your other income. You are able to take 25,000 of that loss that you made in any particular year against the income from your active income. But the second exception, but that has a limit. The moment you make over 100,000, which I want to assume everybody on this call are in that level, the minute you start making over 100,000 and you start losing out on those benefits, and when you get to 150,000, you're done with that passive loss allowance. You can't take it. But again, it doesn't mean that you lose your losses. It just means you have to keep them into the future. But the second exception to the rule that the IRS seeing rental as passive income is if you qualify as real estate professionals. And what then makes you qualify as a real estate professional? There's what we call the more than 50% rule. Your more than 50% of your working hours must be in real estate trade, and which you materially participate, and also the 750-hour rule, where you must spend at least 750 hours on real property businesses during the tax year. But one good thing with that is that if you have 10 properties, you don't have to make 750 property 1, 750 property 2, 750 property. You're just going to kill yourself at that. So, but the IRS allows you to aggregate the activities such that every activity performed for all of the total properties can count towards your 750 hours requirement. And this requirement has to be met by each person. You can't say, okay, we have a partnership because one person is as qualified for this 750 rule, I'm going to attach myself to them, and that means I automatically qualify. No, it has to be met by each individual person. You must meet the 50%, you must meet the 750-hour rule annually to qualify for the real estate professional status. And why are you doing that? You're doing that because as a real estate professional, you are able to deduct all of your passive losses against all of your income, as opposed to the exception that you have for passive investor who can only deduct up to $25,000 if their income, if their modified adjusted gross income is less than 100,000. The exception again to this rule of saying you cannot attach to somebody who meets this qualification to say, she is my partner, that means I qualify. The exception to that is for married couples. So most of the time, I have some of my clients who work, the husband is in the medical, the wife is a laboratory assistant, and because they pay too much in taxes, and they're like, at the end of the day, we'll give you majority of this money to Uncle Sam. Why don't we strategize from consulting? They realize that one person can go after the active income, and the other person can be the one that would qualify as the real estate professional. So in the case of married couple, because at the end of the day, if they are filing their tax return jointly, the one person that qualifies for the real estate professional can rub off on the other spouse who is getting the active income. So that means they are able to deduct all of their losses and block with that one other partner's income from the active sources. So overall, like I said, the IRS categorizes real estate investment income as passive, but the real estate professional, that's what the REP means, can use their real estate investment losses to offset their active income, leading to tremendous tax savings. Let's now talk about the tax benefits of investing in a real estate syndication by being a passive investor. And one of such benefits is depreciation. So let me back up a little bit. Generally speaking, in the world of real estate, if you are not utilizing depreciation, you are on the wrong side of the world. You have to tell so some people came to me sometime last year and they said, I have 5 properties. My tax advisor is afraid to take depreciation. I'm like, why don't they want to take it? They just say it's not a good idea. Run and find someone who is able to help you, because if you don't use it, by the time you're about to sell that property, the IRS don't care. You had the opportunity to use it. They don't care. So Depreciation. And what is depreciation? Depreciation is a cashless expense that creates paper loss. So even though you're getting the cash flow, every month you're collecting your share of whatever was in your agreement with Noblevest. They're giving you, maybe it's monthly, be it quarterly. Even though you're collecting the cash flow, you will not end up paying taxes on those cash flow that you get, because via the power of depreciation, cost segregation, and also cost segregation, bonus depreciation, there's section 179 deduction. With the vehicle of depreciation alone, you are able to create a paper loss. Sometimes they call it phantom deduction, where your inflow, your cash flow doesn't show up anymore. All you are showing is losses. And when you have losses, again, remember, depending on wherever you belong, real estate professional or a passive investor, then you are able to take those losses with you in your tax return. So despite the positive cash flow from a deal, there could still exist taxable loss. So the syndicate investor can use those passive losses to offset any other passive income from another real estate deal or another real estate syndicate or any other business. So if a syndicate investor end up with unallowed losses in a given year, meaning you have exhausted your 25,000 limit, but you still have much more loss that you could not take up simply because you were a passive investment, you do not lose those losses, okay? If you have extra loss every single year and you're not able to take it, you don't lose it. It's just that at that point, you cannot take it. So what you do, and this is where it is important, again, I can't stress it enough, for you to sit down with your tax advisor. Hopefully they are doing tax planning. If they are not, find someone who does tax planning, let them help you plan, and you can always go back to your tax preparer to do the tax preparation for you. Why do I say this? If you feel like you would like, if you say to yourself, I want to harvest some of these losses that I've been bringing from previous years, and you feel like you want to harvest it, your tax advisor should be able to tell you what to do, what you can do to generate peaks. We call it peaks. They are called passive income generator. You need to find some peaks to offset your passive losses. So your tax advisor should be able to give you those ideas. But if they do not, what happens is you keep carrying those losses into the future. And whenever that real estate property is sold, then you are able to capture all your losses at once. You're able to offset all the losses that you've brought all the way forward at once. And then you reap the benefits of the losses, and hopefully it's in the year where you made too much money as well. So the use of passive income generator, PIG, becomes really crucial at this level, and that's where real estate tax planning is important. Another opportunity is the mortgage interest deduction. So one thing is your syndicate, and that's why I like Noblevest. They know the value of tax planning, and they ensure that when they are doing their syndicate tax return, the LLC, whichever LLC you guys fall into, they ensure that they are utilizing effective tax strategies. And that way, with the tax strategies, it flows to you. It's like when you make a provision for your child, when you make retirement planning for your child, if anything happens, they enjoy that benefit. So it flows to them. It flows to you in your K1. That K1 is what you take into your own personal tax return when you're filing your tax. So you enjoy the benefits of mortgage interest deduction. You enjoy the benefits of depreciation. There is no self-employment tax on whatever you earn on a quarterly or monthly basis, on like regular, whenever you get your payments from Noblevest or from any syndication deal. And remember, you enjoy free cash flow because they know what to do to give you enough, to get enough deduction on the syndicate LLC to show paper losses, so you never have to pay tax on the cash that has come to you. Instead, you're carrying losses, you're carrying paper loss, but you did enjoy a lot of cash flow depending on how much your return on the investment is and your percentage. And another benefit with this syndication deal again is you enjoy lower capital gain taxes. By the time the property is sold, hopefully if it's one that was held for a long time, we all know the capital gains tax is lower than your ordinary income tax rate. So you enjoy that, and you are able again to recoup all your losses that you've accumulated from your passive investment on this side of the game. So let's talk about some real estate tax strategies for realtors, because I understand that there are many realtors in the group and as well as business owners. So no matter what you have going on, if you're a real estate agent, Margaret mentioned something in her introduction. She said she started out as a syndicate, and she invested in 1,900 properties. That is the way to do it. If you are a realtor and you have huge commission, instead of paying all this money to Uncle Sam, I encourage and I advise you to get yourself into this syndicate deal as well, so you can enjoy the benefits of the deduction. If you're not doing that, get a property for yourself, get some properties, and you sit down with your advisor, tell them let them make a projection based on your income. How much do they see you paying? I'll give an example. I have a client in-house. If she did not have a real estate business, she had an agency business. And with that business, by the end of the year, she was on her way to paying a huge amount of taxes in the range of millions. I looked at her books because we have the bookkeeping in-house, and I looked at it, I called her to the table and I'm like, okay, if you're not doing anything, I can't sit down and watch you pay this amount. That is what tax advisors ought to do. But majority of the time, people are preparers as opposed to being advisors. They just sit down and wait for you to, at the end of the year, to bring your papers, and you're sweating from your head to toe because you don't even have some of those receipts, you don't even have some of those documentation, and you're leaving so many things on the table. So for you as a realtor, I advise you sit down with your tax advisors, let them look at your income, let them project what you can do before the year is over, because I tell you what, by the minute is December 31st and we'll cross over to the following year, it becomes a little late, because there are so many strategies that you can no longer implement at that time. And that is why there is no better time for you to do tax planning than the starting from the beginning of the year. And the next best time is today. Sit down with your advisor, let them look at different strategies like home office deduction, travel expenses. The IRS, in effective July 1st, 2022, they just increased standard mileage rates for purpose of deductible business expenses. It used to be 58.5 cents per mile. Now, between July to December, it's going to be 62.5 cents per mile. If you are not keeping your mileage, that is something your advisor ought to tell you. For every business owner here, whether you are a realtor or you have other Schedule C businesses or you have an S corporation, keep your mileage, because you know what? This increase that is going to affect July to December 2022 is going to bless your socks off if you have your documentations together and if you're able to track. There are free mileage apps you can just put on your phone, and anywhere you go, they track it up, and you just categorize it as personal or business, and that way you're able to give your documentation. At the end of the day, you have meal categories. Let them look at hiring children and grandparents. Maximize your depreciation. The majority of you want to leave your W-2 job. You want to leave your W-2 job. Before you do that, I want you to take a step back. One, make sure you have savings, enough savings in your account to take you through while you're figuring things out. Two, find out what do you want to do. If you want to go into real estate, ensure that you have a strategic plan. What do you want to do? Do you want to go into flipping? Do you want to be an wholesaler? Do you want to be a passive investor? Do you want to do Airbnb or short-term rentals? Do you want to just hold long-term or flip? Whatever your intent is always very crucial. So make sure you find out what part of real estate you want to do. Find out what your return on investment, your expected ROI that you want to be. Make sure you have it written down. Write down your criteria, and that way you are able to find, when you find a property that fits into your criteria, it will not be difficult for you to identify it and run with it. So make sure that you do your due diligence before you quit your job, so that you don't go in here. Otherwise, start out with investing and then get coaching. Don't just jump in it. Get coaching. I tell you, whatever amount you spend to improve on yourself, improve on your business, that is the secret of Doba. We are not afraid to invest. We invest in the business so much because at the end of the day, we are able to bring more value to the table for our clients. We are able to be like a box of solution providers, as opposed to our clients running helter-skelter looking for solutions. So when you're doing your deduction review with your CPA, let them make sure they are looking at all these different categories, your fringe benefits, your healthcare. Even if you leave your job, you can still get deduction for your healthcare costs. Don't let that hold you back. You can There is nothing, if you want to leave your job, sit down with your tax advisor before you pull the trigger. Let's talk about a taxpayer's journey, which is why I believe that sometimes there is no best time. Sometimes people see this picture, it helps you realize why you need to plan. Today you are in this level. I don't know what your tax return look like, if you're overpaying in taxes and if you're cutting a big check to the IRS. That right there is something that is triggering you to ask tax questions. What am I going to do to ensure I don't pay this much again this same time next year? In your search is where you have something like this. That's why you're here today. That's why you're listening to this program. That's why you're tuning into today's session. You're searching for answers. And at the end of the day, when you're doing tax planning, your advisor is looking at what is the estimated savings calculation that can potentially evolve from all you have going on, not only in the syndicate side of things, but throughout your life, your business life, your earning life. They're able to look at everything in total, not by separating it. And then they make a plan. They make a plan for you on how they will ensure you pay less. Now, it's one thing to do the plan. It's another thing for you to implement. You have to be able to decide. They can give you 20 strategies. How many of these strategies do you want to implement? Let them know. Let them find out if they can help you implement. Decide which strategy you want. Ensure you implement. Because I tell you what, if you have the plan and you don't implement, you've only ended up deceiving yourself. Because come tax time, you're going to save nothing. You will be in the same scenario you used to be before you got started, and you will not be able to help yourself. So make sure you're working with an advisor who will help you with the plan, help you with the implementation to get you to the finish line. Then you file your tax, and then you can be smiling this time next year. Hopefully you're smiling today, but if not, you have an opportunity to smile next year. And what they do is they're looking at how much you hold before. What did you hold this year? Because you didn't do planning, because you didn't sit down with an advisor. What are the strategies that's going to come in between the lines to ensure you don't experience the same situation you're experiencing today? And how much tax are you going to owe after? Sometimes it's not that they might get you to zero. They may get you to zero, but they may not. It depends on how much income you're making. But the difference between what you owe before and what you're going to owe is what is called tax savings. And that tax savings will be looking at your federal side and inclusive of every single state that you operate your business out of. So it should be looking at the total. If they're doing one for you, tell them I want a full package. I don't want a half package. Make sure you get in a full package. And your goal with tax planning services is you want to look at what's the current year situation. What are your deduction review and strategies? They're looking at your legal optimization, legal entity optimization across all of your entities, building you assets protection strategies that will stand the test of time. And you want to make sure it's an asset protection attorney that is doing that, because they are the one that take, when anyone goes to court, they get their attorney to defend them. So the attorney will see it from the lens of their own self, and they can protect you against someone like them. And they look at your core strategy implementation. Again, if you're not implementing, you are deceiving yourself. Something crucial that I see a lot. People go, have tax planning done in 1 year, and they feel, oh, I saved $1 million. Next year, they think they can sit back and not do anything. If you sit back, you're going to go back to where you used to be. So tax planning is what you do year round. 2022, you're doing tax planning. 2023, tax planning. 2024, tax planning. Every single year. Why is that? Your situation of life is not going to be stagnant. No one prays to be in the same situation they were last year. We all want to move forward. Now, as you move forward, you want to carry your tax advisor around. One other advice, make sure you get a CPA or a tax advisor that is able to grow with your firm. If they are too busy for you, then you are in the wrong space, because they will be too busy to sit down with you to plan. And at the end of the day, who is cutting out the check? You are cutting the check. At the end of the day, who is going to be crying for the tax? You would be. What are they going to do? They collect their money and they walk away smiling to the bank. So make sure you're working with a tax attorney, a tax CPA, and your advisor who is able to grow with your firm. Majority of my clients say, I'm leaving because my CPA is not able to grow with me. They cannot answer the questions. I do not promise my client that I have the answers to all questions. No. And I'm saying this to you guys. No one has all the answers. But what differs us from others is we are willing and we have paid our way to be able to find answers. If we don't know it, we will go back to our community. We will do the research. That's instead of you doing the research. Let your CPA do the research for you. throw your questions at them. If they don't have the answer, let them go find the answer, and then they bring it back to the table for you. That way you can focus on what you know to do best, making the money in whatever way, whatever niche you belong to. So your tax planning has to be a year-round thing, year after year. Don't do it 1 year and back out. Make sure you stay consistent, because extension season is only 2 months, between September and October. Tax season is between March and April. Quarterly estimate is quarterly. What is year-round? Tax planning. And for everyone doing tax planning, they should be looking at your entities. You might have 2 entities today. Tomorrow, next year, you might have 5. Next year, you might have additional. You want to make sure that you're keeping your attorney and your CPA together, and your bookkeeper, making sure that you're not leaving any expenses on the table. Majority of the time, people leave so much expenses on the table because they don't remember, they don't have a bookkeeper, they are doing Excel sheets, and you can't keep up with that. So make sure you have a bookkeeper who is tracking all these expenses for you. The power of tax planning is your best vehicle for wealth creation. It's your best vehicle to create your legacy on time. You're able to decide how much you want to pay to the IRS at the end of the day, and you make the decision, you work towards it, and you ensure that's all you pay to them without getting no surprises. That's how you're able to drive the wheel on your numbers. Again, for Doba Tax and Accounting, we look at dozens of strategy. We look at your life holistically. We look at everything. We look at, you tell us your goals. You tell us what you want to do when you are 70 years old, when you're 80 years old. When do you want to retire? Do you want to do charity contribution? What is your greatest fear? Why do you want to do this business? We ask you questions because we want to be in your life to grow with you, to grow with your business, and grow old together with you. So I hope I wasn't too fast, but yes, that's what I got. Margaret, over to you.
Yes, great. Thank you so much. That was amazing, Toby. So at this point, we are going to go ahead and open it up for any questions that people may have. You can go ahead and put them in the chat. And also, we're going to be putting in the chat Toby's Calendly link. She has graciously offered to give a free 15-minute consultation to anyone who's just interested in learning how they can apply tax strategies to their specific situation and ideally save some money. So if you do put your questions in, please use the Q&A feature as well. So, okay, Christine, just put that Calendly link in. Thank you, Christine. Oops, sorry, where am I? Here we go. So you were so thorough, Toby. While we're waiting, are there any questions that tend to come up with clients that you haven't covered? You obviously were extremely thorough with the presentation, but especially as you mentioned, there's a fair amount of realtors in here, even if somebody's not a full-time real estate agent. Personally, what I thought was interesting was making sure you just don't do it 1 year. Maybe you're going to get a bad tax bill and then stop the next. Like, it has to be a consistent situation, right?
Yeah, you always have to make sure that we're looking at the today and then tomorrow, every single year, because your tax strategy, remember when you were introducing yourself, Margaret, you said you started out as a passive investor, and then you started owning properties for yourself. If you had stopped your planning at the point of being a passive investor, then you are not able to harness the opportunities or the potential loopholes that would be available for you when your business models changes. So you want to everyone wants to make sure that you are consistent with your tax planning opportunities. You're carrying your CPA along. Don't make a decision first and then turn around again. But I don't blame people though, because sometimes the CPA is not even available to do the call with them, and they can't reach them after tax season. But that's why you need to make sure that you have the right professionals around you. It's very crucial, very, very crucial.
And I also want to make sure everyone sees that we did put up our contact info, and especially Toby's. We do have her Calendly link in the chat box, but also if you want to email her, there is her email address as well as her phone number. And of course, Christine's and my information. And also, Toby, you were kind enough to mention Nobly Vest several times. As she mentioned, we do offer these passive syndication real estate investing opportunities for people who are either real estate professionals or not, but people who are maybe busy and they need some time and something, frankly, to get a little bit of tax savings. However, what you do need to do is book a call with us, because depending on whether or not you are an accredited investor, we do offer several opportunities where you don't have to be accredited, but we do have to have a personal relationship with you. So it's important that we have that conversation first.
Right. And I really think that everyone who has a plan to retire someday, right? Your 401k is not going to be enough. So the best bet, the best thing you can do for yourself while you still have the energy to make all this extra income is to invest. Your money sitting in the bank does you no good. It's not going to earn the kind of investment, return on investment that you could get from being a passive investor. And then you have all this passive, this opportunity to deduct up to 25,000, even if you're not active. That by itself is a big deal. Your W-2 is limited. You're limited with your W-2. And sometimes it's important for you to bring yourself from the end income to ordinary income. That could simply be by becoming a 1099 employee, a 1099 contractor, as opposed to being an employee. So that way you are able to deduct your home expenses, you're able to deduct your phone calls, deduct utilities, deduct the usage of your car for your business, so many other opportunities. Pay yourself extra and put it in life insurance and let it build up. So it's a whole beautiful world out there for as many as are willing to take the leap. And I'm sure Christine and Margaret are happy to help everyone figure out how much, if you're not accredited, just like you said, how they can integrate you into the system. No one needs to be left out.
Christine, I'm not able to see the Q&A box, so I'm not sure if we have any questions there.
We don't have any questions as of yet. So if there are any questions that you're itching to ask, please, don't be shy. We're here for another couple minutes. And thank you, Toby, for such a thorough presentation. I do want to echo the importance of tax planning because you can save a lot of money. I know for those who are high income earners, taxes really are quite a burden. And so if there are ways to mitigate, and there are through real estate, certainly having a really good CPA professional on your team is very important. So we did get one question in. So here's a question. What should you prepare prior to reaching out to a tax advisor? Great question.
That's a very good question. Before you go, you want to ensure that you know what your present circumstance is, right? Because you need to identify what you want them to achieve for you. And for me, I always ask, what is the pinpoint? Why are you looking to change? So if my question catches you unawares and you're like, but if I don't know what you're hoping to achieve, then I don't even know where to help you from, and I'm not going to fake it. So you need to know what exactly are you looking for, and ask them what strategies are their strategies. Is my entity, you want to be open. Some people want to hold back information. Be willing to open up, because if you're not open enough, they can't even help you. Some people don't even have, and I'm sure whichever tax planner, tax advisor you're talking to wants to know what's your income, wants to know where do you expect your income to be, right? Is there anything you have done previously to mitigate this? If there is it enough, or do we need more? And you want to make sure that you vet, make sure you do your research before you talk to the person, because so many times you are not able to access those people because they have too many clients. I told Kristen, I said, for Doba, we don't take many clients at a time. We take a handful. And the reason is because we don't want to be absent in the life of our clients. We want to make sure that we are there every single time to rub shoulders with them, so that we can know what is the next step and save them and be in their life up to the point where they pay their taxes, or even before and every year going forward.
Yes, absolutely. And I know for us, certainly having your books together for the year really helps because that's your roadmap. Like you can sit down with your tax professional in Q4 and be like, this is what we've done so far. Maybe you have a couple other things you're planning. You want to make a couple investments before the end of the year. It's a great time to discuss that with your tax professional and just assess if that's a good idea, and really what things you can do more specifically to help mitigate some of those tax liabilities. So just having that picture really, really helps, and being organized. Easier said than done. That's definitely my downfall with bookkeeping, but that's certainly something that is very important.
Let me chime in there. Something I see a lot is people want to be their own bookkeeper. You're over there running after 1 million deals, yet you still want to be able to find time to sit down and categorize, categorize your transactions. You still have a family to feed. You have friends to go out to take some drinks with. Give the heavy lifting to the heavy lifters. At the end of the day, you pay them. That is still a deductible expenses. So it's not like you won't get credit. The IRS will pay you to pay your bookkeeper. How about
That's
that? That's the way you partner with them. You partner with the IRS by letting the IRS bear these expenses. Let them take the hunch from your back. Don't stress. Don't give yourself sleepless nights because you want to do, and then you're not even keeping up with the pace because you're growing so big, growing so fast. You can't even do your books. Then give the book to people who that's what they do all their life. So you can have time to do other things. And like Christine said, that book is a major piece. It's easier when you have it together and when you're talking to someone, they say, okay, give me access to see your books, and they can see it. Sometimes all you need to do is defer some income here and there. You know, but if your books is not together, how can we tell?
Yeah.
So Toby, a clarifying question. Does your firm do tax strategy as well as tax preparation?
Yes. So my firm offers bookkeeping for busy investors. We offer tax planning strategies, tax and wealth planning strategies. We offer tax preparation services. But again, we are not that firm who says, approach your life and come to us. We want to make sure you're comfortable to do that. If all we're going to help you do is get your books together and put the plan together, and then will help you implement, because again, I said implementation is very crucial, then you can take the result back to your tax preparer, because some people are like, she's my family friend, we've been together for 50,000 years. Well, you can still keep the relationship. I'm not telling you to disengage the relationship, but let us help you plan, because if they cannot, we work together as a team. If they have questions on the points of preparing and if they don't understand, they can reach out to us. At the end of the day, we all are working for a common goal. Let's save Toby taxes legitimately.
Yes, that's right. And I do want to emphasize that they are very different roles. So your bookkeeper, your tax planner, and your tax filer are 3 separate roles. And sometimes they could be 3 separate people, but your CPA usually doesn't do all of them because it's quite too much. You have a firm, many firms will encompass all 3 aspects, but it's not all on one person's shoulders to do. It is a team, as Toby mentioned, it is a teamwork approach. And it is very important. Each of those legs are very critical to planning for your taxes.
Including your asset protection attorney.
Yes, that's right.
100%.
Yes, absolutely. So how you structure your entities affects how your taxes are approached. So really good point. You have your 4. All right, so we are a little bit over. We're just a minute over. So really great discussions. Thank you so much, Toby, for taking the time and talking with us tonight. And yeah, so if you have any questions, please feel free to reach out directly to Toby, schedule a free consultation with her. And if you want to reach out to us to discuss anything, really, we're always here. Margaret and I are always happy and available to speak with you. So with that.
Thank you so much, Toby, and good night, everybody.
Thank you for having me. Good night, everyone.
All right. Good night.
All right, bye.